China is the world's largest emitter of greenhouse gases. That's why the launch of their first National Emissions Trading Scheme, or ETS, has been watched closely around the world. Carbon trading is the buying and selling of credits that permit a company or other entity to emit a certain amount of carbon dioxide. On China's exchange, the price closed at just under $8 on the first day of trading. A week later, the spot allowance contract price closed up about 11% at $8.80. This is a fraction of the European Union carbon price of just under $59 per tonne. So will the price be enough to drive a reduction in China's emissions?
At prices of 53 yuan, that's far from what would be needed to bend the curve. And particularly given the current structure of the program, where emitters only need to cover the difference between their rate and what are initially pretty generous benchmarks. What this means is initially modest ambition, a desire to walk before running, and this aligns with China's desire for more modest and stable carbon prices in the near to medium term. And this is important, particularly given current concerns around overall price levels and pressures across the commodity sectors and supply chains that we're seeing right now.
But while the prices of China's carbon credits may be lower than in the West, the sheer scale of China's industry makes the trading scheme significant.
Even though at the moment it only includes the power sector, it already covers 40% of China's total emission and close to 15% of the global emission. But more importantly, I think it marks the start of nationwide carbon pricing and sends a clear signal that the government is serious about its 30/60 pledge. Now, that said, it will take time for the ETS market to have a direct impact on the country's emissions. But I think that's okay, because the most important objective of the ETS market at this particular juncture, in my view, is for companies to really buy into the idea of carbon emissions coming at a cost.
And that additional business cost will hopefully encourage more companies to look at renewable energy or alternative fuels.
It sets a right price signal for new technology, green technology, and carbon neutral technologies to come into the market. So effectively, once you cap the emissions from each plant, and you have to pay for extra emissions, what it entails is green technology, renewable energy technologies will get a shot in the arm. In addition, technologies like carbon capture and storage, which are very expensive and commercially unviable today, will benefit from this initiative.
Analysts agree that when a giant like China decides to boost investment in renewables, it will impact the cost and development of such technologies in the region and around the world.
The way this incentive structure is set up is that it's more placing a cost on emitters. So it's giving renewables a relative advantage. When we think about what the power prices are going to be, the power prices will start, can start incorporating some element of carbon pricing, which means there's additional return for non-emitting generation. If we think about decisions on investment on new plants, this is where when you compare the costs of operations, renewables will end up being relatively advantaged by these programs. As China keeps building renewables, this is where the cost of renewables come down for others.
Another longer-term impact could be the trading of carbon credits across borders, or even the start of a new asset class.
If you look at Southeast Asia, multiple countries have already started to think about an ETS kind of mechanism, and different countries are in different stages of setting it up. The second thing which will be more important is have a regional exchange. And that is where it becomes important that we have things like proper monitoring, reporting, verification, so people can put their trust in the carbon exchange. The second step would be to create enough demand and supply of carbon credits so it becomes a vibrant, liquid market where people can not only trade in the spot market, but also in the future market. And this becomes then a tool for people to then meet their climate commitments, which most of the corporates and countries are making.
In the near term, though, potential investors in the renewable and green energy space will need to do their own due diligence.
not all renewable companies are equal. The space is going to get a lot more crowded and a lot more expensive, which makes stock selection the key to a good investment outcome. In general, we believe companies with more pricing power and good management with a solid execution track record is more likely to be the long-term winner. Now, in the midterm, as the ETS expands in scope to include more industrial sectors, companies in those sectors will see their cost structure shift, which also means that companies that are proactively positioning themselves in a low carbon world are more likely to remain competitive. Longer term, carbon permits could become an asset class in itself. Now, as you know, it's not yet open to financial institutions for trading or investment, but that could change over time. We saw the carbon price in EU reaching close to 60 euro earlier this month, rising close to 60% year to date. That could happen in China too over time.